A single Fed decision could cost you $4,200 annually. The Fed's upcoming meeting will shed light on the new chair's strategy, affecting interest rates and the market. You'll learn how this impacts your finances, especially if you have variable rate debts or sensitive investments. But what does this mean for your wallet? The Fed's rate hike could increase borrowing costs. For instance, a $200,000 variable rate mortgage might see a $4,200 annual increase, and a $5,000 credit card balance could incur an additional $200 in interest per year. But this also means savers could earn more on their deposits. Historically, rate hikes have led to increased savings rates, such as in 2006 when the Fed raised rates, and savings rates rose to 5.5%. However, some argue that the current economic climate is different. So, what does this mean for your debt? For example, a $30,000 car loan at 6% interest could cost $6,500 in interest over 5 years, but at 7% interest, that jumps to $7,300. This is a significant increase, and it's essential to consider the impact on your finances. Additionally, the rate hike could lead to decreased purchasing power for consumers. For example, if you're planning to buy a $300,000 house, a 1% increase in mortgage rates could increase your monthly payment by $150. This could lead to a decrease in demand for housing, which in turn could affect the overall economy. But the impact on your finances depends on your individual situation. So, it's crucial to review your budget and adjust accordingly. The next section will explore how to mitigate the effects of the rate hike on your debt. But the part that surprised me most is what this does to your investments, and how a single wrong move could cost you thousands. For instance, did you know that back in 2008, investors who held on to their bond funds during the rate hike saw a significant decrease in value? But those who adjusted their portfolios to include high-yield savings accounts and other rate-sensitive investments were able to mitigate their losses. That is what we will explore next, including a specific example of how a $10,000 investment in a bond fund could lose up to $1,000 in value, and how you can avoid this by diversifying your portfolio. The rate hike could also affect your investments. For example, a $10,000 investment in a bond fund with a 4% yield might see a decrease in value. But a $5,000 investment in a high-yield savings account could earn an additional $200 in interest per year. And some investments, such as real estate investment trusts, REITs, might see an increase in value due to the rate hike. Historically, REITs have performed well during periods of rising interest rates. For instance, in 2015, when the Fed raised rates, the Vanguard Real Estate ETF saw a 10% increase in value. However, it's essential to consider the specific characteristics of your investments and how they might be affected by the rate hike. So, what does this mean for your investment strategy? For example, if you have a $20,000 portfolio with a mix of stocks and bonds, you might want to consider adjusting your asset allocation to mitigate the impact of the rate hike. Additionally, a common misconception is that rate hikes always lead to decreased investment values, but this is not always the case. In fact, some investments, such as those in the financial sector, may see an increase in value due to the rate hike. For instance, back in 2006, when the Fed raised rates, the financial sector saw a significant increase in value, with some stocks rising by up to 20%. The next section will explore how to adjust your investment strategy in response to the rate hike. But what about the long-term effects of the rate hike on the economy, and how it could impact your retirement savings? For example, did you know that back in the 1990s, the Fed's rate hikes led to a period of significant economic growth, but also increased the national debt? That is what we will explore next, including a specific example of how a 1% increase in interest rates could lead to a $10,000 decrease in the value of a $100,000 retirement portfolio, and how you can protect your retirement savings by diversifying your investments and creating a long-term plan. The rate hike could have significant long-term effects on the economy. For example, it could lead to decreased demand for housing, which in turn could affect the overall economy. But it could also lead to increased economic growth, as higher interest rates can attract foreign investment. Historically, rate hikes have been followed by periods of economic growth, such as in the 1990s when the Fed raised rates, and the economy saw a significant expansion. However, the current economic climate is different, and it's essential to consider the potential risks and benefits. So, what does this mean for your financial planning? For example, if you're planning to retire in 10 years, you might want to consider how the rate hike could affect your retirement savings. Additionally, a second-order effect of the rate hike is the potential impact on the job market, as higher interest rates could lead to decreased borrowing and spending, resulting in higher unemployment. For instance, back in 2008, the rate hike led to a significant increase in unemployment, with some industries seeing job losses of up to 20%. To mitigate this risk, it's essential to have a diversified portfolio and a long-term plan. The final section will explore how to respond to the rate hike and protect your finances, including a specific example of how a $50,000 investment in a diversified portfolio could help you weather the economic storm. So, how can you respond to the rate hike and protect your finances? First, review your budget and adjust your spending accordingly. Consider paying off high-interest debt, such as credit card balances, and building an emergency fund. Additionally, consider adjusting your investment strategy to mitigate the impact of the rate hike. For example, you might want to consider investing in assets that historically perform well during periods of rising interest rates, such as REITs. It's also essential to stay informed and adapt to changing economic conditions. Furthermore, consider the impact of the rate hike on your long-term goals, such as retirement or buying a house. For instance, if you're planning to buy a house in the next few years, you might want to consider how the rate hike could affect your mortgage payments. To mitigate this risk, you could consider working with a financial advisor to create a personalized plan. By taking these steps, you can help protect your finances and achieve your long-term goals. Moreover, it's crucial to have a plan in place for potential economic downturns, such as a recession. This could include building an emergency fund, paying off debt, and diversifying your investments. For example, a $10,000 emergency fund could help you cover 3 to 6 months of living expenses in case of a job loss or other financial setback. By being proactive and prepared, you can help mitigate the risks associated with the rate hike and ensure a more stable financial future. In conclusion, the Fed's rate hike could have significant effects on your finances, from increased borrowing costs to decreased purchasing power. To recap, it's essential to review your budget, adjust your investment strategy, and stay informed about changing economic conditions. A key takeaway is to prioritize debt repayment and build an emergency fund to protect yourself from potential economic downturns. Take the first step today by assessing your current financial situation and making a plan to mitigate the effects of the rate hike. Consider working with a financial advisor to create a personalized plan, and start by taking one actionable step, such as paying off a high-interest credit card or investing in a diversified portfolio. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about the Fed rate hike, hit subscribe. I break down one of these every week, and you can join the conversation in the comments below.